Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another episode of the What Matters podcast. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we're honored to have our guest joining us, Bob Fragasso. Bob is the chairman and CEO of Fragasso Financial Advisors in Pittsburgh, Pennsylvania. Bob has been honored by many national and local organizations, including Barron's magazine, and was named most admired CEOs and top executives by Pittsburgh Business Times in 2016 and in 2015 Veteran of the Year by the Veteran Leadership Program of Western Pennsylvania. Bob is also the author and has shared his entrepreneurial wisdom in his book, Starting Your Own Patience, The Independence Guide for Professional Service Providers. Welcome, Bob.
Thank you for inviting me. It's good to be here with you both.
Thanks, Bob. Well, to begin, Bob, your journey in the financial industry spans over 5 decades. Can you share with us your origin story and the early experiences that led to your fascination with finance and then founding Fragasso Financial Advisors?
Well, that's an interesting question, and I'll keep it at the high level because we could take the whole interview with this story. It was a long time back. When I came into the business, I had to make a decision at the time. I was torn between going to law school and coming into the investment business. And I started investing with paper route money way back and always found investing fascinating. So I, for various reasons, chose the investment route, which I'm very pleased to do, have done. And I started in the business in 1972. You read about 1972 in the history books, right, Ashley? Yeah, it was a long time ago. All right, before you, it was BA before Ashley and before Mike. So the reason I'm making a point of that is that at that time commissions were fixed, like airlines had fixed fares. It didn't matter what airline you took. If you were going from Pittsburgh to Chicago, you paid the same rate regardless. There was no competition. So therefore, in our business, the investment business, we were brokers. There was no fee-based investment management. It was brokerage and it was commission based. And on May 1st, 1975, the federal government deregulated that, which sounds like boring old history, but it was cataclysmic. The industry thought it was going down in flames. They referred to it as May Day, May 1st. Mm-hmm. And it didn't know where it was going, the industry, because it had such an investment in infrastructure. And then it broke into 3 troughs. The old line brokerage firms, the names you know, and then the discount brokers, that's where Charles Schwab started that trough. And then finally, there were 2 fledgling organizations that took a holistic approach to investment management, and that's found its way into the certified financial planner mark. And so I allied with that and moved to an affiliation where I could start doing financial planning for clients as the platform for their investment management rather than marketing securities. It's a big shift, and it made all the difference. So if we take it all the way forward, that's how I grew my group within a large national firm that allowed me to do it my way. And then in the 1980s into the 90s, and again, this is the abbreviated version. I could make this a whole 4-credit course if you want. The heavy emphasis by the major firms on proprietary product. So the major firm, meaning it was more profitable for them to market proprietary rather than represent others' product. And so there was heavy emphasis on the proprietary product. They couldn't make me do it, but they made it very uncomfortable not to do it. So I broke our group off in the 90s into a freestanding RIA, and then we've just grown from there. We're a firm of $2 billion under management, and we do investments for individuals, families, multi-generational. We also have a retirement plan management division, and also institutional. That would be for nonprofits, endowments, foundations. And so it's a very satisfying evolution of the business. Over the last several years, we've become an ESOP company, so the employees own it. They're majority owners. And I'm a salaried employee now.
Oh,
That
wow.
means, well, it was part of a transition that had to be. So what it's done is to guarantee perpetuity, help to guarantee perpetuity for the organization. We're well capitalized, very well capitalized. And so while we get offers to merge or be bought, we thank them politely and say, we're not interested. Maybe would you like to sell to us? And then we continue to move on. Our people are divided into departments. Our financial advisors are relationship managers. We have a centralized portfolio management department. We have a marketing department. We have an HR manager. We have a compliance officer. And we have a financial planning department. The industry calls them paraplanners, but the public doesn't know what that means. So we call them financial planning analysts. And they work collaboratively with the advisors and with the portfolio managers. So every client entity gets a team that works with them. Our advisors don't mastermind portfolios. They are in charge of guiding their clients toward their life's goals. And that means being the quarterback of everything that we bring to bear. So that's us. That's the history, and that's where we are now in the synopsis.
Wow. So your advisors are more kind of they don't handle the investments. That's
They
correct?
work collaboratively with the portfolio management. The best way that I can conceptualize it is we believe that asset allocation modeling is the right start to creating a portfolio. And the assets and the percentages of each asset that go into a portfolio are dictated by the financial plan analysis that we do for the client. So it's what are their goals, what's the time frame, what are their family responsibilities, what's their tax bracket, what's their risk tolerance level, what special considerations do they have, what plans do they have intermediate before they get to their long-term goals. And all of that goes into the model that we present to the client. Then that's what the financial advisor and the financial planning analyst work on for the client. Then once that's agreed upon among us, then we bring in portfolio management to populate those sectors with the right securities.
I really like that. So ultimately, you've grown your company organically, correct?
Well, we've made two purchases, and they have been synergistic. We were talking before we started the recording because you have roots in Southwest PA. We're talking about Beaver, PA, where a $2 billion natural gas cracker plant was built. Well, we bought a practice in Beaver because we thought we wanted to have a presence there. That would be an example. So that's sort of organic, even though we bought a practice. That's a natural outgrowth. And the other was a retiring individual who wanted to sell her practice.
Really neat. Yeah, because oftentimes, we've done interviews and, and have met individuals that, they'll have like, you know, $5-6 billion portfolios, but when it's all said and done and you drill into it, their growth is all 1099 advisors that almost is just utilizing them as a TAMP, right? And I
You are
really like
correct.
how you guys have taken, the time to build your AUM, and there's loyalty in the organization with everybody being owners of the organization as well. So have you seen that that's protected, individuals from leaving the company, and have, you've encountered a lot of loyalty because of that?
Mike, both of the things you've said are true, but a lot more. For one thing, there's uniform quality assurance. When you alluded to my book, Starting Your Own Practice Guide for Professional Service Providers. And that's, you can get that. I make $3 on it, so it's more for the benefit of the reader, and it has been beneficial. It's the second edition. I wrote the first edition 15 years ago, and then updated it, published in 2020, and so it's pretty timely. And I talk about three models there. And one is where most people start, and it's what I call the James Bond model, where James does it all. He might be supported by Moneypenny on the admin side and Q on the research side and technical side, but James has to touch every dollar. Well, that's self-limiting. You hit a ceiling, you can only do so much. There are only 7 days, 24 hours in a week. So then where the business owner decides to recruit other advisors, those advisors own their own book. And so that RIA owner is the man or woman who's riding the tiger and can't get off. Because a good friend of mine wanted to merge her practice with ours, and I said I couldn't because she has that model. And it turns out she ended up having to sell to a larger entity because there was no protection, no succession planning. So here, the combination of one synergistic book of business upon which everyone works and common ownership, in my opinion, is far better. Now, having said that, people who put together a 1099 model, which I, by the way, call the real estate office model, right? You have lots of realtors working in your office, and
Right.
oh, Ashley left. Oh, I didn't know that. I didn't know Ashley came. Was she here? They don't coordinate with each other. They might know each other socially, but they're running their own little book of business. That doesn't get the quality assurance to the client, and it definitely doesn't provide the protection that you alluded to, Mike. And then finally, it doesn't build real equity for the owner
Right.
or owners.
Right.
I think this model is far better, and I think the industry is moving in that direction. The RIA industry is moving in that direction.
Yeah, look, I can tell you as being a managing partner of a private equity fund that buys minority stakes in RIAs, the valuation on having centralized W-2 employees as opposed to having a giant book of 1099 employees is far different. I don't want to give multiples over the podcast, but it's an enormous range, and the reason why is because a lot of these individuals that are 1099, they can go they for the most part can take their book of business, has more of a chance of leaving with them, and they're never selling the firm, they're just selling themselves, right?
Exactly.
So yeah, I respect the way that you've grown your company. That's amazing.
Well, I think everybody wins with that. That's why we keep more than 99% of our employees. You asked that question earlier.
Wow.
Or pose that as an outcome, and we keep more than 99% of our clients. It seems to work. The quality assurance is there.
How
We
many
have
employees?
generation of clients.
Oh, I think, Mike, we were both about to ask the same question.
Go ahead.
Yeah. And so how many employees do you guys have now?
44.
44. Wow.
Yeah. We're very process driven. As I like to say, process trumps personal brilliance. You can't be bright every minute of every day, but if you have the right process, I mean, there's a reason why there's a process manual for an aircraft carrier or a fighter jet. You can't just make it up every day. Did we check everything? I don't know. You check it. It can't be that way. So if you're process driven, then you're free to be creative on the stuff you really can be creative with, instead of having to think about all the minute details every day and make it up as you go.
Right. And how many of those 44 employees are advisors?
About a third.
Okay.
Now, and the reason that I say it that way is, for example, the people who run our retirement plan advisory department are advisors, but they're working on retirement plans. So they're not advisors in the common way of guiding clients, but they are guiding institutional clients. Or if a foundation, that advisor is an advisor, but it's dealing with a nonprofit and a foundation. So we've got probably a better ratio than the Army. We have fewer support people than the Army needs to field the infantry.
So I had a question. This leans towards my curiosity with having everybody as you said, as shareholders or owners of the organization. How long do they have to be at the company before that takes place? And were there individuals that started the company with you that are obviously still there, that, that run the company more on a day-to-day now, or are you still,
The firm,
involved?
no, it's a good question. Again, it cannot be founder centric. One embarking on this course has to set his or her ego aside and say, this is not for my aggrandizement. This is for the betterment of. I like the idea that we have relatives working in the firm. I like the idea that somebody can bring their children into the firm or their grandchildren into the firm. It's a meritocracy, but still, isn't it great that families are being raised and kids are going to college and that maybe the next generation's coming in? We've had so many of our employees' children work as interns while they were in college, and they may circle around and come back. One of our top FAs came to job shadow me when she was a sophomore in college. She's a grandmother now. So,
Wow.
there's continuity here. But and I'm sorry, circle me back to the beginning sentence that you started because I wanted to make a point.
I was asking, in regards to everyone being a shareholder or employee, how long are they usually at the organization
Thank you.
before that takes place?
Thank you. You'll get old someday too, so you'll see. You need to get brought back to your point. Everyone at the time we did the ESOP, and we did it in 2 tranches. We did half and then the other half, and there was a reason for it because we didn't want to retard the growth of the firm by eating up all the capital just to sell the shares to the ESOP. It works like a retirement plan with a vesting schedule. So everyone who was there then participates. And then people who may, and they are here now too. We also established a sinking fund in which we pay every month so that when people retire, and we do have people approaching retirement age, that the money is definitely there to buy their shares. And then it's reallocated out among all the people who are employees there. So there is a feeling of ownership throughout the company, and will continue as there are changes inevitably. The firm is managed by a 4-person executive team who also serve as the trustees of the ESOP. And then we have department managers. So there's a manager over all of the financial advisors. There's a manager who manages the financial planning analyst. There's a manager of portfolio management department, a manager of compliance, a manager of marketing. Those are operational managers who are responsible for their personnel in their department. And then they report to one of the 4 executive team members. So as I like to say, if I drop dead tomorrow, I guess we'll close for the funeral, but business goes on, for a day so they can go to the reception after, but business will go on. And that's the way it should be structured. It's not a monument to me. It's something we all built together.
Really cool.
Yeah, so you have extensive experience in this industry, Bob. I'm sure you've had plenty of specific experiences you can recall, but to our listeners, can you share a client experience where you felt like you made a significant impact? And what made it special for you?
Oh, there's so much. There's so many that I could give you. Maybe one that years ago, husband and wife became clients. I used to give a lot of, at the time, this is pre-internet, I did a lot of financial education through the colleges, community as well as 4-year colleges, and people would come to my classes. And this particular couple came to one of my classes, which happened to be at the local library because I did the educational classes there too in community centers. And they became clients and valued clients and helped guide them from middle age through into retirement. Their only son had a very notable career and went through his career and has since retired. You would know who he is. He's fairly well known. And now his children have wonderful careers. Now, I could give you example after example that are similar to that, but I use that as an example of where the gratification comes. Yes, there are people who come in, they're in tears. the spouse died. The deceased spouse took care of everything. And it isn't just male, female. It can go the other way too. And we're able to straighten it out for them and make sure that they're going to be okay. I mean, you can't guarantee anything, but put them in a position to help assure their future. It's every day. So I could give you one example after another, but that three generation is not uncommon. And by the way, the wife in the original first generation lived to be over 100.
Wow.
One of my first clients when I got into the business lived to be 103. So helping guy, and he's a very knowledgeable guy, officer of a publicly traded company, but he's not an expert in what we do. So helping people move toward their life's fulfillment, because money's the facilitator, it's not the end. You know, Scrooge McDuck used to swim in his swimming pool full of money, but that's not what our clients do. They want the money to get them to what they really want for their family and themselves.
Right. And I'm sure
And,
just so.
Oh,
I was gonna say, I'm sure it's just so fulfilling too to just see generation after generation, and that trust continues down that lineage.
Absolutely.
Yeah. Wow. It's beautiful.
Well,
yeah,
and that's
and
where the planning comes in too. If I might add that postscript, because you can't just guide the first generation.
Right.
The money's not going with them when they go, so it's coordinating all the generations. It helps them, and it's good for us too. I'm sorry, Mike.
Yeah, and the thing is, you know, just because people know how to make money doesn't mean they know how to invest it. And look, I'll be the first to say that, you know, making money has always been something that's been fairly easy for me. But I am an absolute horrible investor. So I mean, I'm absolutely horrible. So, you know, fortunately, when I sold my company previously to starting this, you know, private equity fund, I had given 70% of it to my advisor, to my wealth management company, because Lord knows the 30 or 35% that I peeled off is non-existent, right? So, you know, it's very, you know, I've always felt that it's very important, you know, to trust advisors and you know, and let me ask you this question here. You said you peeled off in the 90s, right?
Mm-hmm.
You know, so my twin brother, who's one of my business partners, we were having this talk yesterday, and he was telling me that this whole privatized wealth management is just something that's been really a big push in the last 20, 30 years. And before that, it was all wirehouses. Would you say that's
no
correct?
question. Yeah, I'll give you the short version. When I came into the business in 72, it was predominantly partners capital firms. Merrill Lynch, as an example, was considered a national firm, but they had an office in New York, they had an office in Philadelphia, they had an office in Pittsburgh, Cleveland, they hopscotched. They weren't Main Street. But when commissions became unfixed, the partners capital firms, the one that I started with in training, could not continue because the decreased commissions competing with the discount brokers, they couldn't keep their infrastructure going. So they had to fold or sell. So there was an amalgamation. And here I'm coming to the answer to your question. There was an amalgamation through the late 70s into the 80s, where firms were mega firms or mega regionals, at least. The small firms didn't exist anymore, by and large. Then when airlines were deregulated, our industry was deregulated. Well, Ma Bell was broken up. And that was the beginning of the technology revolution. Everything came out of Bell Labs before that for communication in this country. So when that was broken up, it was the beginning, and it ushered in the Apples and the Microsofts and the personal computer, which is the key to what you're asking. So now we had the implosion. Now we're having the explosion. So the ability to run a firm like ours, yours, on a series of linked personal computers now existed at that point in history. And you could break off and you could access all the research. You could access the bond inventories. You could get to whatever it is you needed to run your firm and compete with anybody. Then when the large wirehouses realized that they had an infrastructure that they couldn't support, and they either had to slash the size of their firms, and I could give you names and people involved in names you would know today because I was involved meeting with them where we were housed, they had to go proprietary product to generate revenue. So they wanted the manufacturing product profit as well as the advocacy, the retail. Then fee-based management started, and it started predominantly with E.F. Hutton, and then it was bought, and then it went up through. But even at that point, they were holding tight rein on the fee-based product that we could use. It wasn't us doing management for a fee. It was they doing management for a fee, and we were finders. So if you had any entrepreneurial spirit at all and a computer, you could break it off. So now there was an explosion, and that was the beginning of the RIA revolution, which began in the late 80s. My first computers were Radio Shack. The first one had 8K of RAM. You changed the screen, got a cup of coffee, you came back, it was ready for you. And then the next one was 16K of RAM. All right, well, when IBM came in and then Apple came in,
Yeah.
I still see the newspaper. Apple put a full-page ad in the Journal welcoming IBM to the industry. Very cheeky. And then the competition started. Now we had real computing power, and for the reasons that I described, the big firms put the squeeze on the employees. And we just peeled off from there. I took at that time my 11-person group that I had grown entrepreneurially and started our own RIA. And you could clear through, and that's where the custodial business started too. Now you can get the best custodianship is available for relatively cheap cost.
Yeah, because isn't it, usually the custodials are what, Schwab, Pershing, right?
Pershing, LPL,
LPL. Gotcha.
Fidelity.
So there's only a few custodials out there still.
Yeah, there's a handful. And what's happened over the last couple of years, because the custodians were charging a dollar fee for custody for transactions, which we paid. All right. You could pass it on to the client, and that was okay too. But that was our cost of doing business. And then for competitive reasons, they went to no fee custodianship, and they were making their money on margin and free cash balances. They say they're very profitable with that, and their P&L would show that they are. But what that's done is that put a great demand for scale on these custodians. And so they had to buy each other up. TD Ameritrade bought Scottsdale, and then Schwab bought TD Ameritrade, and from there. So we're down to a handful of custodians at this point.
Yeah.
And then there are others that are looking at coming into the business, big names. They're looking at coming into the business, and they're looking at the revenue model. So the only constant is change. So we as RIA owners have to have our eye on where it's going, and where we spend a fair amount of time doing that. And that's part of what I do, and our company president does, and our CFO and our EVP, the four on the executive team. We're looking at what's going on in the industry. We're not jumping around. That's not our model. That's not the way we think. But we're also not going to be caught flat-footed. And I would urge all the RIA owners listening that they not be caught flat-footed.
And that segues perfectly kind of into the next question I want to ask you there, Bob. From your perspective, what emerging trends and technologies or strategies do you believe will shape the future landscape of wealth management, especially, in the next decade?
I think a lot of what we're seeing right now is going to remain constant, but the smaller RIA is finding it hard to be competitive. And so they're going to have to merge into a larger one or buy other smaller ones and become larger, so that they have the revenue flow to be able to pay for the resources. So the trend is heightened technology leading to sophisticated processes. And you're agreeing with me, Mike. That's what you're seeing, I think, when you evaluate firms. So that's where the industry's going. I don't think we're going to ever return to the dominance of the wirehouses. That's a different model entirely. And they're part of a larger conglomerate that sees revenue from different sources and cross-selling. But the sorry, Mike, go ahead.
Oh, I was saying, sorry to interject there because I had this question on mind. When you say the smaller RIA, would you care to give like, for our viewers, the size,
50 million, 100 million, that's pretty hard
Gotcha.
to, you got to get up to 500 million at least, and then the entry, I guess the lowest common denominator for scale would be $1 billion.
Mm-hmm.
Gotcha.
And I don't want to brag too much about having 2 billion because I think that's just a benchmark along the way to 5 million and 10 million and so on. Now, we don't have the TAMP model you talked about. We don't have the 1099 model. So I could build our AUM if I wanted to get a bunch of real estate the real estate office model in, but that would pollute what we're doing. So we need to build it planably, and as you said, predominantly organically. And if we buy a practice, we're not going to buy a practice with a lot of small households. That's not productive either. We have independent advisors who plug in. We have that available to them, to our resources. We provide them with the software to run their practice. We provide them with the financial planning software. We provide them with the models, and we help them. We don't run their business for them. They're entrepreneurs, but we give them what they need at scale, and it's a revenue sharing arrangement. But that's not the business we're in. We do that because they need it and because we have a minimum, and below that we don't accept. So when people come to us because of our activity, we're able to send them out to our associated advisors, and they're able to handle them with quality assurance because they have to use our portfolio management.
Gotcha.
If they did their own portfolio management, they don't fit in with us because we're not going to spend our days looking over their shoulder to make sure they're not getting everybody in trouble. So if they use, and that's the greatest problem is in portfolio management. You forget about money conversion because there's systems built to counter that. But it's portfolio management decisions that get the RIAs in trouble. So if they use our quality assured portfolio management, they're safe, we're safe, and they get all the really good tools that we have available that we use. But that's where the industry is going, Ashley, to your question, is that kind of consolidation.
So let me ask you this: with that being said, what you said before there, you said you guys are at 2 billion. That's just your segue into 5 billion, then 10 billion. What's your, I would say, 1 to 5 year goal there for the firm? Where what's the goal for you guys to get to in AUM?
We do 3-year strategic plans, and so our strategic plan would be minimum would be to grow 10% a year, and target would be 15% a year. Again, we want to do this slowly and planably. We don't want to bring in assets that don't fit. So, for example, with clients, at the very, very far end of conservatism, the client that's so fearful, we can't help them. At the very other end, they want to roll the dice and double up, we can't help them. But the broad swath in the middle who are serious about their future, we can help them. So we move methodically. The same thing's true if we were to acquire a practice. First, we would have to have a co-buyer, one of our associated advisors, to take the lower end of the book, and then we would take the upper end. The clients would get the same portfolio management, but the big cost is in servicing the accounts, the labor cost of servicing the accounts, even with good processes. So that's why we have a goal of 10 to 15% a year. When someone says, I'm going to grow 50% a year, I'm saying, what do you have, 25 million? If you have a big amount of money and you want to do it planably and absorb and not disrupt your culture, 10 to 15% is fine. Thank you very much.
Oh, yeah,
that's great. Yeah.
And do you guys plan on getting there all organically or through inorganic growth as well?
We will get there organically. The exception would be if associated advisors want to affix themselves to us, that's good. We don't have a giant program and we're not paying transition money because you're your own business. We're not paying people to come and attach onto us, but we'll provide everything they need. But that's an adjunct to what we do. We might buy a practice, but it would only be if the book of the seller is synergistic with what we're doing. I mean, think about large company mergers, how often they fail. And you're going to deal with someone who's done something for 35 years and you're going to bring him or her in and they don't want to do it your way. Why are we doing this?
Right. Right. You're absolutely right about that. I think that when it's all said and done, if you bring a lot of individuals that are not culturally aligned, you start running on a treadmill because people start leaving when newer people come, and before you know it, there's no culture in the organization.
That only works if your goal is to flip the firm, get to a certain critical mass and flip. That's not where we are. Our people are going to continue to own the firm. So we want like-minded people associated with us and like-minded clients. That's where the quality comes.
And Bob, are there any specific sectors or investments that currently pique your interest or excite you for potential avenues of wealth creation?
We, as we talked about, we are totally committed to asset allocation, have been for decades, and will not veer from that. But within the segments that we put in to the asset allocation model, there are complementary ways to populate. So let's take fixed income as an example, which had been a problem because one, for a long time, it was low yield. Then when interest rates went up, the existing bonds went down in value. So we got a double whammy with that. So we try to manage that as one example, the fixed income segment of the portfolio using alternative investments that provide income, but it's more assured and less subject to fluctuation. So it could be real estate, it could be credit. There are a lot of ways in which but again, that's why having more affluent clients, we're able to put that in their portfolio because they have the room for it. It dampens down the volatility of the portfolio, provides more income. So that's the way we look at, as opposed to, and I'll tell you what we won't look at is anything that doesn't have any earnings or anything that's so trendy and faddish. We had people who said we were behind the times because we wouldn't do crypto. Well, thanks. You go do crypto. We're not going to do
We saw how that worked out.
Yeah, exactly. So, yeah, we try to be clients don't pay us to hit home runs every day. They pay us to protect their money and to have it grow planably.
Yeah, I think I had one more question there, for you. And with where the 10-year treasury is gone for individuals that are, buying homes and, credit card debt, car loans. We've obviously seen it a lot. We fluctuated from 2020 with it going down to 0.5% all the way to it touching 5%, within a month or so ago. I know home mortgage interest rates were, above 8% for a hot second there. Car loans have, went, to 10 or 11%. So ultimately, we're seeing something that we haven't seen in a really long time. I was born in the late 70s, so I got to experience a little bit of this. But I know that you've got to see this, firsthand, and saw what happened to the interest rates back then. And I wouldn't say this is as bad as what happened, back then, but what's your prediction of the market? Where do you see the market, the stock market going? Where do you see the bond market going? If you can elaborate, that'd be great.
Let me break that into two parts, again, keeping it at a high level. If we look back at that time that you're talking about, when you were being born and I was going into CFPdom and studying for my CFP designation, interest rates had gone up a lot in the 70s because of the doubling of oil twice. So we went into the late 70s and early 80s with very high interest rates, which killed the value of any bonds that were issued before that. So that was pretty devastating. I wasn't in a position at that time to have the kind of resources behind me that I had. So I had to scramble to try to do damage control for clients. So at that time, I took a very simplistic approach, and it could work today, approaching today, and that's laddered bonds on a 5-year laddered scale. And that protected clients' fixed income for a long time through that. And then we were able to get more sophisticated ways of managing maturities. And also, instead of buying individual bonds at the retail level, we were able to move to the institutional. All of that has been repeated now over the last couple of years with interest rates going up. Everything I just said about the late 70s to early 80s. Then Paul Volcker, the Fed chairman at the time in the early 80s in 1982, choked the economy into submission by raising interest rates to 12, 15, 16%. And it was like pulling the emergency brake on the train. It just screeched to a halt. And then we had to come back. But it ushered in a really good period of real values and that was Bonfire of the Vanities and all of that, and Red Suspenders, and all the things you read about in the history of it. But then we got into 90 with the recession of 90, and then we got up working our way through the 90s, all good periods. But it happened because interest rates stabilized after they went up so dramatically. So we had 20 years of good market, and then we had the dot-com bubble, and then we had everything else we know about now, 07, 08. But we've managed well through all of that. Now, can I predict the future? No. But I do believe that history repeats itself. It just gets dressed a little bit differently. So if you look at that scenario I just described to you, there is a good argument. Let me add one more fact. When we came out of the pandemic, wasn't as bad as 07, 08, but the Federal Reserve had lowered interest rates. The federal government had flooded the economy with money.
Mm-hmm.
And don't ever doubt this maxim. Someone taught it to me decades ago. The economy will move on availability of money. Developers will develop on availability of money. You have cheap money, things are going to go.
Mm-hmm.
So we're bringing inflation down. Interest rates will come down. We may have a good period moving forward. Now, people will jump all over me, and you'll get me on social media and say, what about the war in the Middle East? And what about, it's a horrible thing. But markets don't move on international events. They move for a few days on international events. They move with the basics of the economy, our economy and the world economy. And that's moving in a pretty good direction long term. Look at the diversification from China's production that's happening slowly. But we're diversifying our supply chain. We're onshoring some of our supply chain. We are getting, a lot of people don't like labor unions. I'm not a labor union person, but if working people of all stripes are getting a living wage, Henry Ford discovered this in the 20s, they will buy more goods and services. It will be good for the economy. And that's what's happening now. So if you don't like paying your wait staff what you're paying them in tips and prices of food, don't cry because the train's coming. Get on the train, go with it, because that's what's happening here. So I think we're moving to a pretty good time in the economy. Will it be bumpless? No, of course not. The meaning of life is a wavy line. There'll still be ups and downs. But I think the fundamentals of the economy are lining up pretty well.
I appreciate that.
Yeah, that's some great points there. Well, Bob, I think we're just running close on time here today, but thank you so much for sharing your incredible insights with us. It's truly been a pleasure having you on the show with us today.
You've been very kind to ask me those questions and allow me to share, so thank you.
Thanks, Bob. And to our listeners, we hope you enjoyed today's conversation with Bob. Be sure to check out Bob's book, Starting Your Own Practice, The Independence Guide for Professional Service Providers, for more insights and wisdom. And stay tuned for exciting interviews with individuals who are making a meaningful impact in the world of wealth management. Until next time, remember, it's not about wealth, it's about what matters. Thanks, Bob. Thanks, listeners.